The gap is widening. Paper markets show $94 per ounce, but the physical price, 170. 70% of deliverable silver vanished in 6 years. COMEX vaults are draining, Eastern markets absorbing everything. The system built on leverage now demanding metal in hand, and within days, possibly hours, silver crosses $100. But that's not the story. The story is what happens when the paper illusion finally shatters. What comes next will redefine wealth preservation for a generation. Welcome to John Analyst, where we decode the signals the mainstream overlooks. Now, if you've lived long enough to see currencies rise and fall, if you remember when a handshake meant something and a dollar bought more than memories, then do me a favor, hit that subscribe button, not for me, but because the information coming your way could be the difference between preparation and regret. And tell me, where in this world are you watching from today? Are you in the States, Europe, Asia, or somewhere witnessing this unfold firsthand? Drop your location in the comments. Let's see how global this awakening truly is. Now, let's get into what's really happening. Silver sits at $94 per ounce, just $6 away from a number that hasn't been seen in generations, a psychological barrier that changes everything. $100. For those watching the markets closely, this isn't just another price milestone. This is the moment when decades of patience, years of doubt, and months of explosive growth all converge into something undeniable. A year ago, silver traded at $30. 30. Anyone holding silver then, anyone who ignored the skeptics and the naysayers, has watched their position climb 155%. Not in a decade, not in 5 years, in 12 months. To put that in perspective, silver outperformed every major asset class on the planet. Platinum rose 137%. Palladium gained ground. Gold climbed steadily. Even coffee saw impressive returns. But silver? Silver dominated them all. For 15 years, silver struggled. It languished in the shadow of gold. Investors called it volatile, unpredictable, a poor store of value. They pointed to its wild swings, its failure to hold gains, its reputation as the metal that never quite delivered on its promise. And then, everything changed. The transformation didn't happen overnight. It built slowly, methodically, driven by forces most people weren't paying attention to. Industrial demand shifted, supply chains tightened, central banks printed currency at unprecedented levels, and quietly, almost invisibly, silver began its ascent. Now, as it approaches $100, a critical question emerges. Is this the peak, or is this just the beginning? To answer that, one must understand what this number represents. $100 isn't arbitrary. It's a psychological threshold. When silver crosses it, headlines will scream, mainstream media will notice, investors who ignored precious metals for years will suddenly pay attention, but there's something else happening beneath the surface, something far more significant than headlines. The gold to silver ratio, a metric watched by every serious precious metals investor, is collapsing. A year ago, it took 100 ounces of silver to equal 1 ounce of gold. That ratio reflected silver's undervaluation, its status as the overlooked stepchild of precious metals. Today, that ratio sits at 50 to 1. It has been cut in half. What does that mean? It means silver is being revalued, not by speculators or retail investors chasing trends, but by institutional players recognizing its fundamental worth. When major financial entities shift capital, when they recalculate risk and reposition assets, ratios like this move, and they're moving fast. Some analysts believe the ratio could tighten further, perhaps to 40 to 1, maybe even 30 to 1. Others argue it will reverse, that gold will reassert dominance and the ratio will widen back to 60 or 70 to 1. But here's what nobody disputes. The ratio's compression signals a market in transition. Capital is relocating. Investors are reassessing. And silver, for the first time in decades, is being taken seriously. The question isn't whether silver deserves this attention. The question is what happens when $100 breaks. Because historically, psychological barriers don't just get crossed, they get shattered. When gold broke $1,000, it didn't stop there. When Bitcoin crossed 10,000, it kept climbing. Psychological thresholds act as catalysts. They trigger momentum. They bring in new buyers. They create self-reinforcing cycles. And silver, with its unique position as both a monetary asset and an industrial necessity, sits at the intersection of multiple converging forces. This isn't speculation. This isn't hype. This is pattern recognition based on decades of market behavior. The investors who positioned themselves in silver years ago, the ones who accumulated when it was $20, $30, even $50, are now watching their foresight pay off. But the real question, the one that matters most, isn't about the past. It's about what comes next. Because if $100 is just a waypoint, if the structural forces driving silver are as powerful as the data suggests, then this story is far from over. In fact, it may have only just begun. The pieces are in place. The momentum is building, and the market, indifferent to hope or fear, continues its relentless march forward. What happens at $100 will set the tone for everything that follows. Something strange is happening in the vaults. COMEX, the largest commodities exchange in the Western world, stores silver for delivery. Investors, institutions, traders, all rely on these inventories to settle contracts. The system depends on metal being available when someone demands it, but the metal is disappearing. Since 2020, registered inventories have dropped 70%. 70% gone. Not sold to jewelers, not melted down for industrial use. Simply relocated, moved, transferred from west to east in a quiet exodus that few people outside professional trading circles even noticed. Until now. Because when 70% of deliverable silver vanishes in 6 years, the market stops functioning the way it's supposed to, and cracks begin to show. Here's where it gets interesting. Right now, 2 versions of silver exist, 2 completely different prices, trading simultaneously in parallel universes that shouldn't exist in a rational market. On paper, silver trades at $94 per ounce, futures contracts, exchange-traded funds, financial instruments that represent silver without requiring actual metal, all reflect this price. Investors watch their screens, see $94, and assume that's the real value. But walk into a dealer, try to buy physical silver in quantity, ask for immediate delivery. The price? $170 per ounce, $170. That's not a typo. That's not a premium on collectible coins or numismatic rarities. That's the price for standard bullion, the basic product, metal in hand. So which price is real? The answer is both. And that's the problem. The $94 price reflects paper trading, contracts that settle in cash, agreements that never require actual metal to change hands. It's a price determined by leverage, by margin, by the assumption that most people will never ask for delivery. The $170 price reflects scarcity. It reflects the cost of acquiring physical metal in a market where supply can't keep up with demand. It reflects reality. And the gap between these 2 prices, this $76 divergence, tells a story more powerful than any headline. It tells the story of a market under stress. In normal conditions, futures prices and physical prices stay close. Small premiums exist, maybe 5%, maybe 10% to cover handling and logistics. But when physical metal trades at 80% above paper, that's not normal market function, that's breakdown. Traders have a term for this phenomenon, backwardation. In a healthy commodity market, future delivery costs more than immediate delivery. Why? Because storing metal, insuring it, financing it, all cost money. So a contract for delivery 6 months from now should trade at a premium to today's price. But when that relationship inverts, when immediate delivery costs more than future delivery, it signals one thing: physical shortage. Silver has been trading in backwardation. Not occasionally, not as a brief anomaly, persistently. The market is screaming, "We need metal now, and we'll pay extra to get it." And where's that metal going? East, Shanghai Metal Exchange, Chinese vaults, Asian refiners. They're absorbing silver at unprecedented rates. The West built its financial system on paper contracts and fractional reserves. The East is demanding the actual metal. And COMEX, the institution that's supposed to ensure market stability, is running out of ammunition. Every time someone stands for delivery, every time a contract holder says, "I don't want cash, I want the actual silver," the registered inventory drops further. The exchange can't print more metal. It can't create supply with a keystroke. So it does what institutions always do when facing pressure they can't control. It changes the rules, margin requirements. The amount of capital needed to trade silver contracts have been raised repeatedly. Why? To cool the market, to discourage speculation, to reduce the number of contracts that might demand delivery. But here's what those margin increases really signal: desperation. When an exchange raises margins in a rising market, it's not protecting investors. It's protecting itself. It's trying to slow down a train that's already left the station, because the fundamental problem hasn't changed. Demand exceeds supply. Physical buyers want metal, and the vaults, once considered bottomless, are running dry. The fractional reserve system worked perfectly, as long as nobody asked for their metal back. But now, they're asking, and the divergence between paper and physical, between perception and reality, grows wider every day. This isn't a temporary dislocation. This isn't a quirk that will resolve itself when markets calm down. This is structural, and it's accelerating. The question isn't whether this system can hold. The question is what happens when it breaks. There's a reason governments are paying attention now. In 2025, the United States did something it rarely does. It added silver to the official critical metals list, not gold. Gold didn't make the cut, silver did. That designation, quiet as it was, carries weight. When a government labels something critical, it's not making a casual observation. It's acknowledging dependency. It's admitting that without this material, essential systems stop functioning. And silver? Silver is everywhere. Every smartphone in every pocket contains it. Every solar panel generating electricity requires it. Every military radar system tracking threats across borders depends on it. Every electric vehicle battery, every 5G network, every advanced medical device, they all need silver, not as a luxury, as a necessity. This is where silver separates itself from every other precious metal. Gold sits in vaults, it stores value, it hedges inflation, but it doesn't do anything. Platinum has industrial uses, palladium powers catalytic converters, but neither carries the dual identity that silver does. Silver is money, and silver is infrastructure. It conducts electricity better than any other metal. It reflects light with unmatched efficiency. It kills bacteria naturally, making it essential in medical applications. And it doesn't degrade. A circuit board built with silver today will function the same way 50 years from now. But here's the problem. You can't replace it. Engineers have tried. Laboratories have tested alternatives. Copper works, but not as well. Aluminum conducts, but corrodes. Graphene shows promise, but remains experimental and expensive. When a solar panel manufacturer builds a panel, they need silver. When a defense contractor assembles a missile guidance system, they need silver. When an automaker installs sensors in an electric vehicle, they need silver. And right now, the world is building more of all three than ever before. The solar industry alone is consuming silver at rates that would have seemed impossible a decade ago. Every year, more panels go up. Every year, efficiency improves, which paradoxically requires more silver per panel, not less. The energy transition everyone talks about, the shift from fossil fuels to renewables, that transition runs on silver. Wind turbines need it. Battery storage systems need it. Smart grids coordinating power distribution across cities, they need it too. And military demand, that's not slowing down. If anything, it's intensifying. Modern warfare isn't fought with tanks and infantry alone. It's fought with drones, satellites, electronic countermeasures, precision-guided systems, all of them silver-intensive, all of them considered non-negotiable for national security. So when industrial demand surges, when governments classify silver as critical, when solar installations double and electric vehicle production scales, where does the supply come from? It doesn't, not fast enough. Mining silver isn't like turning on a faucet. A new mine takes 7 to 10 years from discovery to production. Exploration, permitting, environmental reviews, infrastructure development, financing, all of it moves slowly. And most silver isn't even mined as a primary product. 70% comes as a byproduct of copper, lead, zinc mining. That means silver supply depends on the economics of completely different metals. If copper prices drop, mines slow down, and silver supply contracts. Even if silver prices are soaring, the supply chain has no quick fix, no emergency reserves, no strategic stockpile that governments can tap when shortages hit. Refineries can't work faster than chemistry allows. Logistics can't move metal faster than ships and trucks permit. And recycling, while growing, can't possibly keep pace with new demand. This is why institutional investors are repositioning. They're not chasing price momentum. They're reading supply constraints. They're calculating future demand. They're recognizing that silver sits at a structural choke point, where multiple essential industries compete for finite supply. And some institutions positioned themselves years ago. JP Morgan Chase holds significant silver positions, not as speculation, as strategic allocation. Because when a metal becomes critical, when supply tightens, when industrial users start bidding against each other, the holders of physical inventory gain leverage. This isn't conspiracy, this is market structure. Smart capital doesn't wait for shortages to appear, it anticipates them. It positions before the crowd arrives. And when scarcity finally becomes obvious, it's already too late to acquire at reasonable prices. The critical metals designation, the industrial demand surge, the supply response lag, these aren't separate trends, they're connected. And they're all pointing in the same direction. Because here's what most investors miss. When a metal transitions from useful to critical, its valuation framework changes entirely. It's no longer priced based on mining costs or historical averages. It's priced based on what users are willing to pay to keep their systems running. And when those users include governments, militaries, and infrastructure developers building the energy grid of the future, they'll pay whatever it takes. The metal that powers everything is running out, and the world is just starting to notice. The timeline is shrinking. Days, maybe hours. Separate silver from $100. Traders watch tick by tick. Institutional desks monitor flows. And somewhere in the background, the machinery of price discovery grinds toward an inevitable conclusion. But crossing 100 isn't the end of anything. It's the beginning. Because what happens at psychological thresholds isn't rational. It's reflexive. When barriers break, momentum accelerates. New buyers arrive, media coverage expands, and price targets that seemed absurd just weeks earlier suddenly appear conservative. Some analysts have already made their calls. $139, $200, $300. These aren't fringe predictions from newsletter writers chasing clicks. These are institutional forecasts, backed by supply-demand models, structural analysis, and historical precedent. Kitco, the respected metals research firm, published a $300 target, not as sensationalism, as baseline projection based on current trajectories, $300. If that sounds impossible, consider where silver sat 12 months ago, $30. Anyone suggesting $94 would have been dismissed. Yet here we are. The question isn't whether aggressive targets are possible. The question is whether the structural forces driving this move are sustainable. And the evidence suggests they are, because the physical market, the actual metal changing hands, is already pricing in scarcity. The U.S. Mint, the official producer of American silver coins, is charging premiums that dwarf anything seen in normal markets. Those premiums, the gap between spot price and retail price, have exploded. Not because of greed, because of supply stress. When manufacturers can't get metal, when delays stretch from days to weeks, when buyers queue for allocation, premiums rise. It's not manipulation, it's mathematics. And it's happening globally. European dealers, Asian refiners, North American distributors, all report the same conditions. Tight supply, rising premiums, longer wait times. The retail market, often dismissed as noise by institutional traders, is flashing the same warning signal as COMEX vaults and Shanghai exchanges. Physical silver is harder to acquire than the $94 price suggests. But here's where caution enters the picture. Markets don't move in straight lines, corrections happen, volatility spikes, and even within powerful bull markets, painful drawdowns occur. The gold to silver ratio, currently at 50-1, could reverse. It could widen back to 60, 70, even 80-1. That wouldn't invalidate the structural thesis. It would simply reflect normal market breathing. Anyone entering this market now needs to understand that reality. Because the worst decisions happen when emotion overrides strategy. Someone watching silver hit 100, feeling the fear of missing out, might liquidate everything and go all in. That's not investing. That's gambling. Proper allocation, even in asymmetric opportunities, requires discipline. For someone with $50,000 in capital, putting the entire amount into silver would be reckless, even if silver doubles, even if it triples. Because diversification isn't about limiting upside, it's about surviving downside. A more measured approach, allocate 20 to 30% into silver, another 10% into palladium or platinum, add copper exposure, hold gold as portfolio ballast, keep cash reserves for opportunities that emerge during volatility. This approach doesn't maximize theoretical gains, it maximizes probability of staying in the game. And in markets like these, staying in the game is what matters most, because silver's rise isn't happening in isolation. It's happening against a backdrop of currency devaluation, debt expansion, and monetary system stress. Global debt has surpassed $300 trillion. Central banks continue printing. Fiat currencies lose purchasing power daily. And the systems built on infinite credit expansion show cracks. In that environment, hard assets aren't speculative, they're defensive. But even defensive positioning requires strategy. For new participants, the worst approach is trying to time perfection, waiting for the perfect entry, hoping for a pullback that may never come. Better approach, systematic accumulation. Buy a fixed dollar amount weekly or bi-weekly. Let dollar cost averaging smooth out volatility. Build positions incrementally without trying to outsmart the market. This method removes emotion. It creates consistency. And over time, it delivers better results than trying to catch exact bottoms. Because here's what experience teaches. Nobody, not professional traders, not institutional desks, not the most sophisticated algorithms, can consistently time markets perfectly. The goal isn't perfection. The goal is participation. And right now, participation means recognizing that silver, with all its volatility, with all its risks, represents something rare. A structural imbalance playing out in real time, supply that can't adjust quickly, demand that keeps accelerating, inventory depletion that's measurable, price divergence that's widening. These conditions don't resolve overnight. They build, they compound. And eventually, they break. The $100 threshold is where perception shifts, where mainstream attention arrives, where the narrative changes from silver might do something to silver is doing something. And what comes after depends entirely on how long the structural imbalance persists. If mining production surges, if industrial demand plateaus, if recycling ramps dramatically, the story changes. But none of those things happen quickly, which means the current trajectory has room to run. How far? Nobody knows. But the data, the inventory levels, the physical premiums, the industrial demand forecasts, all point the same direction. Up, the breaking point isn't $100. The breaking point is when the paper system and the physical reality can no longer pretend to be the same market. And that moment is approaching fast.